there was a recent report issued by the New York University Stern School that made what might be considered a startling observation, but not particularly surprising. And that was that venture capitalists largely fund people who look like themselves. So if less than 1% of venture capital-backed company founders are African American, and 87% are Caucasian American, and 12% are Asian American, what does that really say about the likelihood of innovation being set forth by African Americans and Latinos and Native Americans getting the kind of funding that they need?
Okay, so is that just an open question?
Just open it to each one of you, whoever wants to respond.
Well, I should give the commissioner, maybe first up, let's see what's. Thank you very much, and I want to thank STEM for having us here. One of the things that I would say is that we always have to remember that human nature is what it is. And, you know, birds of a feather tend to flock together. But the question becomes, how do you get from that point to where assets are being distributed, even if not more equally, but more equitably? In one of my past lives, I used to run a development corporation, a not-for-profit in New York City. And we used to work with a lot of small businesses in the neighborhood where the development corporation was located. And the issue of access to capital was always an issue for the small businesses trying to grow. One of the things that we were able to do, because as you mentioned, the issue of people working with those who, let's not just say look like them, but who they're more comfortable with and who they understand, and who they can kind of see themselves as. So one of the things we were able to do, and I think this is where the issue of partnerships can come into play. I had worked for another organization that had gotten a federal fund from the Economic Development Agency to run a small business lending fund. And what we were able to do with the corporation I was at now was partner with JP Chase, who said, you know what? We have problems both on size-wise and on knowing some of these small businesses and what's real and what the risks are in making these kind of loans. Some of them are smaller than we would like to do because of what it costs us for a loan officer to make these loans, but what they need, which will help them grow, is smaller than what suits our needs. So, in addition, sometimes there are risks involved in these companies that we're not prepared to evaluate. But you guys know them. You work with them every day. You know what this situation is. So here's what we want to do. We want to take a chunk of our money, a small chunk, mind you, but we want to take a chunk of our money, give it to you, and you will make the credit decisions instead. So that's what we did. We started a small revolving loan fund. It was a micro loan fund, no more than about $10,000 for a company in which we were able to assist a startup enterprise, a minority woman-owned enterprise, a couple minority male-owned enterprises, and make loans to their projects. One of them we did have a problem with, but the issue was that that was one of the things we were given the money for, to take risk that the banks were not willing to take because it doesn't show up good on their books. But we're able to help these businesses grow and start up and create enterprises because we were on the ground and we didn't have the issue, we didn't have the separation issue, perhaps, that the majority of venture funds or even banks may have from the community on the ground. So the issue of partnering and saying, look, I don't know them, but you know them. So can we work with you to get the money to them through you?
Thank you. Does anyone else want to take that?
Sure, I'll take it. So first of all, a couple of housekeeping things. First of all, to Talib, thank you very much for inviting me here today. I really appreciate the invitation. Second of all, I see some of my SEC colleagues here in the room, so they know what's coming next, which I have to say that any of the views that I express are my own and do not necessarily reflect the views of anyone else on the commission itself, or any of the staff members at the commission. Now, with that out of the way, Sometimes I start off when I speak to groups with sort of half-jokingly say, I'm here from the government, I'm here to help. But I think the question that was asked here is I think government policy is actually part of the problem. So in the securities world, so if somebody wants to invest in a company, right, and people think of the SEC, if you want to, the companies that we typically regulate are companies that have IPO, they have gone public, right? So they've already raised a bunch of venture capital money, they go public. But we also have a lot of what we do is in the realm of private companies, private offerings before they go public, right? So venture cap funds or funds that receive, or companies that receive private equity funding and all that sort of thing. And when I say that government's the problem here, the reason why I think that's the case is because in the federal securities realm, and through regulation and through the laws, we've divided up the world, we meaning my predecessors have divided up the world into what we call so-called accredited investors and so-called non-accredited investors. And in the interest of trying to quote-unquote protect non-accredited investors are expressly prohibited from investing in certain types of securities offerings, of which you think of the Silicon Valley type firms have already been offering all along. So only the accredited investors get to invest in these companies, right? And there's this new term now I've heard called unicorns, which are private companies in Silicon Valley that have over $1 billion valuations. So what that means is that the accredited investors, and I'll get to how we define them in a second, have gotten the benefit of investing in these companies when they've gone from $0 to $1 billion and have gotten to capture all those returns, right? The non-accredited investors, and I don't fit the definition, have to sit on the sidelines and wait until they go public, and by then a lot of the high growth and high returns, maybe are still, some of it's still there, but most of it's gone. How do we define accredited investors in the securities laws? Well, it's supposed to proxy for sophistication. So the idea is we'll protect, quote unquote, the unsophisticated investors and let the sophisticated investors invest in these securities. How do we define sophistication? If you're rich. If you have a high net worth or if you have a high income, you're accredited and you're considered sophisticated and you're allowed to invest in these potentially high risky, but I used to be a finance professor, high risk equals high return companies. And in the name of protection, non-accredited investors are prohibited from investing in those types of securities. And what I've been trying to do in my role as commissioner is to point out to people, even if you think these securities are riskier, these companies are riskier. We've got a lot of Silicon Valley companies, got a lot of biotech companies out there, right? Someone might be the next Facebook. Someone might be the next, blockbuster drug. We don't know which one it is. On an individual basis, yes, perhaps they are riskier, but investors invest in portfolios of securities, and they add securities to an existing set of portfolios. And in fact, even if you add a security, a company that in isolation is riskier than what you already have, if it's not correlated with what you already have, and there's some portfolio math here, I used to teach this, Finance 101 is you teach portfolio math and talk about how your portfolio risk can actually go down by adding riskier securities. And what I've been advocating for, and actually the Dodd-Frank Act allowed the SEC to revisit this accredited investor definition. And people have been focusing on, oh, should we ratchet up or down the net worth requirement or the income requirement? I say let's just get rid of the whole thing. What we want to do is open up for investments for anyone. Get rid of this artificial distinction, right? Because it's disproportionately affecting certain segments of the population, right? Let's get rid of that, and then a lot of the other benefits will actually flow from that. And so that's where I think actually the government policy is actually part of the problem here.
Well, hello, everybody. Thank you for having all of us. Those are two sets of comments that are going to be hard to follow. I'm going to give you the perspective from a venture capital perspective. I used to be one when I was in the private sector before the president appointed me, and I was one of a handful of, in my case, Hispanic, but we can broaden that to minorities, so African American or Hispanic American, that actually manage money. There's very few of us, very correct, and handful. I lived in New York before I got appointed to this job, and in this job, I run a program called the SBIC program in which we provide leverage for venture capital funds to invest in small businesses. Currently, there's $25 billion under management in that program. There's 303 funds. Only a handful of those funds are fully owned by either women and/or minorities. But if I expand the definition to look at, do the funds have a partner, which is either a woman and/or a minority, the number goes to 50 out of 300, which is about 18%. It doesn't sound high, but it's actually extremely high when you compare it to the rest of the world. You threw out a statistic about 1% of the venture capital being managed by African Americans, and a very small portion, fraction of that is actually Latinos. So the question then becomes, are we looking at the problem the right way? And I would posit to say that the answer to that is only partially. Because a real question we should ask is the fact that the business is actually an apprenticeship business, and an apprenticeship business requires a pipeline of talent. And the reasons there's so few, and the answer to your original question is, if there are more African Americans managing money, will they invest in more African American businesses? Empirically and conceptually, the answer is unequivocally, because they're going to be cognizant of that, but they're going to be looking for good deals. What matters is good deals. So the issue of wealth creation, which is something that Mike just touched on, which is if underserved communities, as the African American community has been and continues to be, are not able to create the wealth required to enhance businesses that are owned by African Americans, you end up in a cycle that's never going to unlock. So the fact that underrepresented groups have not been able to participate because of policy or because of inherent bias, purposeful or not, or because of whatever, there is actually a real issue. But I believe that we're in a good place. We're going to talk about STEM in a second. Technology has democratized almost every single thing. Hiring people, getting a taxi, eventually when the SEC, and I'm not speaking for the SEC here, gets crowdfunding, equity crowdfunding through, it democratizes capital access. There's all kinds of things technology is doing. I think that's going to be important to help answer this question. So very near and dear to my heart, and it seems like everybody here.
Thank you. A very large perspective, looking at this question from various vantage points. Sort of undergirding this, though, do you know of any actual venture capital funds or incubators or accelerators that are actually targeting women or African American or Latino or Native American innovators? Does that exist? Can you talk about that?
Not a Muslim, I don't know. I work with them.
Okay.
I'm happy to take that because I think I know. Hopefully I'll be able to elucidate a little bit. The answer to that is yes. Venture capital, private equity, alternative principal investing is driven by returns. Period, pure and simple. The fiduciaries demand it. There's a new movement that is getting institutionalized called mission-driven investing, impact investing. Anybody heard of this? Social entrepreneurship. And the premise behind the mission-driven investing or impact investing is the sole purpose of a corporation to maximize shareholder wealth? That's the premise we've been going under for the last 50 years. And a lot of people are going, definitely the main purpose. I don't know if it's the sole purpose. And I agree with that. Most people agree with that, at least conceptually. So there are funds that exist on the venture capital side that are doing impact-driven investment that are focused on this because they believe that investing in low and moderate income areas, which are sadly populated disproportionately by minorities, is of a high impact to the country. Accelerators and incubators. I happen to run another program called the Growth Accelerator Fund, in which we provide cash to ecosystems around the nation. The national innovation ecosystem has changed. And it started really to get blown up around the 1970s. Up until about the 1970s, innovation happened in a nexus of government, companies, and the military. Teflon was invented in DuPont. General Electric came up with the light bulb, at least the first. That is no longer the case. Innovation happens in small companies. And when that ecosystem started breaking up, so did the capital sources to fund that innovation, because the companies like DuPont would fund Teflon and would have the scientists. Now you have venture capital everywhere. You have scientists everywhere. You have people pursuing entrepreneurial careers as a choice, not as a thing you do when you get fired. So it's an actual career path, right? You choose to be an entrepreneur, that's going to be your career. So there has to be an ecosystem that supports all that. And all these models have been springing up, incubators, accelerators, shared office spaces that actually provide some of that ecosystem. And there's about 2,000 in the United States, of which 126 of them have won some of the prizes in the program I lead. Out of those 126, almost every single one has an overt, even though it's not their sole purpose, an overt mission to actually serve the underserved. And there are some ones, like City Labs in North Carolina, Manos Accelerators in San Jose, which is focused on the Hispanic community. There's one in New York on 62nd and Broadway, which is focused on African-American-owned businesses. So there is a subsection of the entrepreneurial ecosystem that actually is doing this, but they're doing it not because it's just, but also because it's good business, right? And that's kind of the premise of having the niche. The answer is yes.
Okay. So, go ahead, please.
Oh, so, my answer to your question is I don't know of any, but at the commission we should know, and beyond that, actually, we are required to know. We need to figure this out. And the reason why is because there's something in the Dodd-Frank Act, the Dodd-Frank Consumer Financial Protection Act, called Section 342, authored by Congresswoman Maxine Waters, which requires all financial regulators, including the SEC, to do diversity outreach initiatives. And one of the things that we need to do at the SEC, and I'm just going to read this, it says we need to partner with organizations that are focused on developing opportunities for minorities and women, to place talented young minorities and women in industry, internships, summer employment, and full-time positions. So the venture cap industry is solely within our regulatory purview. And we have a wonderful woman named Pam Gibbs, who I'm hoping shows up at some point today, who's the director of our Office of Minority and Women Inclusion. And she's engaging in outreach efforts right now to the regulated entities, all the entities that the SEC regulates. And we typically you think of the things like the Wall Street banks and maybe the asset management firms and that sort of stuff. But we need to do better and reach out to more of these, the venture cap funds and the incubator funds and that sort of stuff. It's on the agenda. If there's people in the audience that are aware of these things, and I'm certainly going to now reach out to Javier on this, we need to know this, and we should know this, and we need to get better at it.
Okay. Now, so we talked a little bit about what the cause is for some of the problems, what the role of government might be in helping to solve it, what policy changes might be made, how the Small Business Administration is playing a role here. But you also mentioned something about pipeline development, or I thought I heard a little bit about that. And, that relates to, where does the pipeline come from? Where does it originate from? So tech companies are reporting sort of dismal figures in the diversity in their ranks. Google, as an example, reports that African Americans and Latinos comprise just 3% of their worldwide staff. Only 30% of Google's employees are women, and there is not a single female executive. African Americans and Latinos are also largely absent among the ranks of tech executives. So we know this to be true. Now, there has been suggested that there is a correlation between the lack of tech diverse entrepreneurs and tech executives. Do you believe this to be true? And what can you say about it? What accounts for that, and what can we do to address that?
Well, I think you have to look at this on multiple levels. And before I start, now I have to give the commissioner same disclaimer of, I'm now speaking on my own behalf, not on behalf of NASDAQ, especially since you started out in your example using a NASDAQ-listed company, of which many of these companies that you would probably discuss in this issue are listed on us. But I'm going to go back, you talk about tech executives, and it's not that there aren't qualified people to be that. We're still dealing with a number of issues in regards to even being given real opportunities, even having companies, particularly on the tech side, that have true diversity initiatives where they are expanding the base of where they look, their sources of looking, of where they're going to get both minority and female executives from, as opposed to, I know a guy who knows a guy who knows a guy. But I'm going to take it back further than that, even thinking about, you know, being at university. And this is something that I've been discussing with a number of people in regards to the education process, where you will find that many cases, minorities in undergraduate school are steered away from the text, from the sciences, from the maths, from the technology issues, going back to and push towards psychology and sociology and other majors and English, and not that there's anything wrong with these, but the fact of the matter is that if the push is that we're not going to have them major in these, then their opportunities of getting positions in these firms is going to be decreased, which means the opportunities to move up and then understand the business from the inside so that they can decide, well, now it's time for me to take off on my own. So you mentioned pipeline, and the pipeline starts at the education level, long before it gets to the executive level or the entrepreneurship I need to access venture capital level. So we're dealing with a problem right on the educational level that needs to be addressed.
Anyone else want to take that? And I'll follow that up because it's going to go to the heart of the question around, you know, what's the role of the STEM program? How does that fit into developing the pipeline? So,
Sure, I just want to follow on just quickly what you were talking about. It does begin at the education level. Now, at the SEC, we don't have much on the tech companies themselves, right? The companies, we think of them as companies that then issue the securities to the public, right? But we do have a direct line into the pipeline development of the investors who invest in those securities and the financial institutions that facilitate the underwriting of those securities and the trading of those securities, like NASDAQ. So not only do we have outreach efforts to the regulated entities themselves, but Section 342 of Dodd-Frank that I mentioned earlier specifically tells us we need to focus on pipeline development. And so that's why when I go out, I used to be a former finance professor, as I mentioned, and I'll talk to any student anytime, anywhere about anything, right? Because, you know, like this audience, you gotta kind of listen to us, and it's actually very therapeutic, right? You can sit and talk to folks, whatever, right? But it's very easy for me to go talk to student organizations, and particularly, I was just down at University of South Carolina talking to the Black Law Students Association. I was at Drexel University talking to the Women in Business. And these are folks that are thinking about careers in either, you know, securities law or working for the financial institutions. And they're trying to, you know, talk about, you know, how the SEC and how these firms are focusing on diversity and how that actually makes these better companies and how they can actually sell that as a value-added part of their portfolio of their human capital when they go to these things. And so pipeline development is hugely important, and, you know, it's got to begin at the education level.
Just a quick comment. I couldn't agree more that the pipeline actually begins very, very early. 6 out of 10 degrees in the United States are now handed to women, and actually almost 50% of all degrees in the United States are of women degrees are STEM degrees. So there is no real reason why there's such an underrepresentation, except when you broadly define pipeline. A window that I can tell you that I have into this is something called the SBIR program, which I also run for the SBA. It stands for Small Business Innovation Research. The federal government spends $135 billion on research and development. Very, very forward-looking, innovation-driven, STEM-driven research projects, everything from floating windmills to composite materials to make cars lighter, to you name it. Storage, energy storage systems, all kinds of stuff. Out of that 135 billion, I oversee 3. And that 3 billion is granted to small, innovative businesses to participate in that federal research. And small businesses are where most underserved groups begin. So when I look at begin their careers, because you hope every small business wants to become the next unicorn. Right? Every small business wants to be a big business, right? Let's start with that. Very few actually want to stay small, family-owned businesses, and kind of the backbone of small business America wants to stay small, the cupcake shop. But what we're talking about here is not that. We're talking about here is scaling to real size and affect real economic development driven by innovation. So, out of that $3 billion, about 7,000 grants in a broad swath of the American innovation economy, and we are #1 by far because we spend trillions, but we're not alone. Because now China's throwing 500,000 people to figure out the Mars problem. And you got Germany subsidizing manufacturing. The reason Germany makes the best products is because the government actually subsidizes manufacturing industries. But let's leave that aside. The issue is that we are probably not addressing all of the pieces of the pipeline. And when I talk, even in universities, you mentioned USC, even in universities, people don't know about this particular program, which happens to be the largest seed fund in the world. And when you talk to somebody in Cambridge, Palo Alto, New York, Manhattan, and then I'll say New York City, Manhattan, or Austin, everybody knows about it. But once you leave those places, crickets. So we're not doing a good job of actually addressing the pipeline. And that requires a lot of focus. So there's a piece of it that's outreach, there's a piece of it that is focus, and there's a piece of it that's the reality. Women disproportionately don't like to take loans or equity for investment, and that is empirically correct. Now, a lot of people will argue the reasons why, but it's a fact. Now, is it because they're less risk takers? I don't know. There's a lot of women in the audience. I don't know. Some people would argue that, yes, they don't like to take that much risk, which is why do you not have as many blow-ups as men have, right? But is that right? Right, so I think that the pipeline issue is probably the biggest thing for us to focus on, yes.
So how can, it's the biggest issue that we should focus on. How can, from all of your perspectives, what can your particular agencies or industries do to add more to that focus? What do we do?
Well, one of the things that we are doing, NASDAQ has an educational foundation, and often it's particularly supported universities and other things related to finance. You know, it's interesting because we, as a company, we come under finance, such as we're regulated by the SEC.
You're welcome.
Most of the laws that affect us come out of the Financial Services Committee. But as was mentioned when I first got there, we're actually more of a technology company than we are a finance company, because of the fact that we don't actually, we're on neither the buy side or the sell side of the deals. We're the technology that allows the buy and sell sides to meet. So one of the things that we are doing, which is brand new for us, to get more, close to the ground, because most of the companies that deal with this are one of two type. As Mike had mentioned before, the company that is ready to go public, or already is public and list on us. Or you're talking about the broker-dealer community, those in finance, who are trading on our systems. But now we're looking a little closer to the ground. So as of September 24th, next week, we are opening our first NASDAQ Entrepreneurial Center. And that'll be opened in San Francisco. And the whole focus of it will be so that people who have ideas, minorities, women, anybody, Cajun male, whatever the case may be, who have ideas. This is what we believe in, helping people who have ideas turn those ideas into reality. but it'll be an opportunity where you don't necessarily have to start out with big money or anything like that. You just want to know, how do I get started? How do I meet venture capital people? How do I develop a business plan, a marketing plan? This way it gets us closer to the ground on helping everybody who's interested learn how to develop that business idea that they have and turn it into a reality.
Well, that's the first I heard about that new entrepreneurship center. That sounds like I need to take a trip to San Francisco to go see this. That's good.
You'd be more than welcome.
Yeah, there we go. I mean, we have, as I mentioned, what could we do, right? I think it's getting in front of as many students as possible. Like I say, I make a conscious effort when we go to universities, but actually, the commission has a long history of the employees on an individual basis going out in the community right now in the high schools. I think it starts even earlier, right? And if students aren't exposed to thinking about going into STEM or those types of careers in high school, then what makes us think that they're going to all of a sudden turn on a dime and be prepared to do it in college? We need to actually do it in the high school level. And we have a number of talented individuals at the commission who, will take on their own time, go out, and there's all kinds of very good organizations within the district, in the public schools and in the private schools, mostly in the public schools, to go and like reading programs with the students or help them tutor them and those types of things. And just that little bit of attention, you never know. It's almost like seed funding, right? Investing in these people, right? And to me, it's investing in human capital. If you think about what makes this country great in terms of what we have, it's the human capital, the potential that we have, right? You think of the student, particularly in the energy sector and in technology and in the STEM sector and stuff. Students, individuals move from job to job to job. What do they take with them? It's their human capital, right? And if we can make early investments in that at the high school level, or even maybe down into the elementary school level as well too, just to get a little bit of a spark, right? Just like the early stage investments in companies, just that little bit of extra capital can be that spark to do that. We can unleash the potential of students as well too.
So we know what we should be doing, or have some ideas about what we should be doing, and that is looking toward the future. But when we turn to what is happening today, if there is a person out there that is an entrepreneur, is an innovator, and is looking to receive access to capital and believes that they have been denied that because of their gender or their race, is there any recourse? What can they do? So
Javier mentioned crowdfunding, right? And this is a new framework that allows for more of the non-accredited investors to invest in sort of mom and pop ventures, although with caps based upon your gross income and that sort of stuff as well too. What I see our role at the commission is to help with that, is to provide as many alternatives to those people out there, right? Javier, I think, used the phrase democratizing access to capital, right? If we can open up more avenues for folks to provide capital, then we can open up more avenues for people to access that capital. If they face a dead end somewhere, well, they just go somewhere else, right? And the more that we can open that up, the more that'll help unleash the potential. For me, the commission, we have a three-part mission: protect investors, maintain fairly efficient markets, and facilitate capital formation, this access to capital. And this third piece is often a forgotten part of the mission. People think of us protecting investors, all the enforcement cases we do. Maintain fair, orderly, and efficient markets, right? Everything we do to regulate the stock exchanges and the broker-dealers and all that sort of stuff. But this access to capital, to me, is the most important piece. And to me, it's nothing less than keeping the American dream alive. Because for some people, that American dream is taking their entrepreneurial spirit and putting it into action. And starting a company, hiring workers, taking a product or service to market, and improving the lives of all the workers that work for them and everyone that goes out and buys their product or service. For other people, the American dream is taking their hard-earned savings from their jobs and investing in that entrepreneurial spirit of those other people. And why should we limit access for both directions on this? It's absolutely crazy to me. And they take that and they invest it and they use it for their retirement or to improve the lives of their children by putting them in for education and putting them through college. So for me, this access to capital is nothing less than helping people invest in the American dream by investing in each other.
I want to, let me give you a picture of, I first would like to look at the framework before trying to ascertain, well, why does a deal doesn't raise the money? Let me give you some facts. Of all small businesses in the country trying to raise capital, only 0.04%, that's 0.04%, this is according to the National Venture Capital Association, raise money from venture capitalists. That leaves 99.96% of all small businesses raising capital without access to institutional venture capital. Period. Next sentence. The Angel Capital Association, which is another association that looks at kind of this patient capital formation area, estimates that about 0.9% of small businesses looking for capital raise capital from angels. So if you add those up, you still have more than 99% of the small businesses in the United States that are looking for capital, not accessing capital, back to capital formation pathways that Mike was mentioning. Now, out of that 99+%, probably 90% don't have any business trying to raise capital. The ideas may be bad, they're half-baked, whatever it may be. So but that still leaves you with 10%. And by the way, 10%, just to give you a sense, there's 28 million small businesses in the United States. That's businesses with less than 500 employees. Of those 28 million businesses, about 500,000 of those are considered high-growth, fast job creators. Out of those 500,000, about 200,000 are always looking for money. So in terms of scale, that's kind of what we're talking about, give or take. That's the bad news. The good news, well, there's a little bit more of bad news. The crisis, I'm just putting the reality of what the crisis did, and a lot of the Dodd-Frank that was born out of that. So the crisis created a situation where assets consolidated further. There's about 6,500 banks in the United States, give or take. Out of those 6,500 banks have about $14 trillion in assets. 5 banks control $7 trillion. The next 15 banks control another $6 trillion. So if you couldn't follow, 20 out of 6,500 banks control 13 out of $14 trillion. What does that mean to small businesses? I'm going to tell you what it means. It means that because banks became bigger, they would prefer to write bigger checks because of scale, because of fiduciary responsibilities, because they perceive bigger deals or bigger checks as less risky. So there's actually an institutional backbone issue that happened with the consolidation. That same consolidation happened in the equity markets. Private equity funds have gotten bigger. Venture capital funds have gotten also bigger. Okay, that's a lot of bad news. Let me tell you about the good news. America, like Mike said, is built on the backs of amazing entrepreneurs that want to take risk, take the ideas to scale and change the world. Who has a Facebook account? Who has an iPhone? Right, on and on and on. American entrepreneurs. Those two didn't finish college, but that's another thing. Education is good, education is good. The two people that started the company. So, but that innovation actually translates to innovation like what Jamil was saying about innovation in the ecosystem. So crowdfunding is one such innovation. It's not only equity crowdfunding, but crowd rewards, crowd donations, you name it, crowdsourcing. There's peer-to-peer lending. There's community and community development financial institutions that fill some of the gaps at the bottom end of the market. The MBDA, which I think you did some time at the MBDA, Jamil. No? Oh, okay. My bad.
That was another guy.
That was another guy. MBDA is very focused on getting access to capital to small businesses, but via contracting with the federal government, who happens to be the biggest buyer of things in the world. It spends $500 billion a year, again, $500 billion with a T, buying things and services. So the realities of this consolidated financial world issue, chasing returns, are reality. is being upended at the bottom end of the market by all these interesting and amazing innovations. Oh, and by the way, you don't need that much money to start a company. You can join an accelerator. You don't have to rent office space, and that costs you $200 a month or something like that. You don't have to buy computers and servers because you can rent it as a service, right? A SaaS. You don't have to hire people because there's a lot of free agents that are really good. So starting a business has never actually been easier. So the roadways to actually growing businesses because of necessity have become a lot more nimble. That's a very long answer, non-answer. Thank you so much.
Thank you.
Let me give you this,
Sure.
just one other point, because I know this question lots has to do with policy. And obviously, we are near the center of policy here in Washington, D.C. And I spent, before I went to NASDAQ, I spent 10 years working with somebody on the Financial Services Committee. But the issue sometimes with this issue of what do you do, how do you make sure that they're this isn't like housing discrimination. These are, like you said, most of the funds, an overwhelming number of funds are not coming from VCs anyway, or angel investors. And the issue becomes one, and like I said, as someone who's done lending in a few places, you do deal with the issue also of, I remember I had somebody come into me and say, well, the money's for the community, so you're going to give me some, right? And it's like, yes, the money is for the community, but I'm not going to give you anything. You're going to convince me. I want this money to revolve, which means I want to give it to somebody who's going to use it, invest it, make a profit, give me my money back, so I can then give it to somebody else. So you have to convince me that you're a good investment, not assume that because it's there. Yes, I'm trying to target a certain area, but that doesn't mean everybody, it's not an entitlement. But from a policy point of view, if you're looking at, well, if there are other barriers for people who do have good ideas, but they're not getting it for some biased reason or just don't know reason, whatever the case may be, often the first thing is look at what are punishments and things like that. But sometimes that's not always the issue. You have heaven and hell, you have the carrot and the stick. But sometimes what you really need more is the carrot. What you need is the incentive. What is a good reason? There's nothing that will push business like, this is good for me. This is a good, like when you talk about the diversity as a whole, most people who have good diversity programs will tell you it has been good for business. It's not about it being the right thing to do. It is. But when you're trying to get people to change, the issue is what is in it for them? What is their incentive to do it? So part of what we have to look at when we discuss policymakers with people like Ms. Waters, Mr. Meeks, and a lot of members of CBC, and you're trying to get out of it, for those people who have control of the resources, have control of the funds, what do they want? What can you offer them to broaden their outreach to a larger community? Because if they see it as good business for them, then once they see that, you no longer have to incentivize them. They're going to go on and do it. You don't have to look at how, what protections there are and so on and so forth. They're going to do it because it's good business. I remember the former Fed chairman in discussing the issue of the community reinvestment and how a lot of banks, even though they had been hesitant at first, when they realized how many people from minority communities wanted to own homes and buy homes and were making this their priority and paying it back, they ultimately said, CRA is good business, plain and simple. It's not about, oh, I have to, I don't want to. It's about, I have a portfolio that makes me money, and that's what I've been business for. So from a policy point of view, that's what we have to look at. What are the needs of those with the resources, and how do we incentivize them to put it to a broader area?
Thank you. So we have looked at this from several different perspectives. What are the problems? What are the potential solutions? What are the realities of the situation that we all have to contend with? So for this audience, I would like to hear from each of you is, what is the takeaway? What is the takeaway from all of this from your various perspectives as to how we move this needle forward? And I'll start with Commissioner Pinawa?
Yeah, I mean, for us, it's just continuing to do outreach in our diversity initiatives, as I mentioned, under Section 342 of Dodd-Frank, right? We got the office in 5 short years, got the office up and running and started reaching out, like I said, to the regulated entities. And you know, what I learned from this is that pipeline is really, really important, and we need to start ramping up our activities in those areas as well, too.
Thank you. Administrator Saeed?
Yes. So I think the biggest message here is that even though our country does have some moles and nooks and crannies, and there's injustice, and look, where I come from, Puerto Rico is in a huge fiscal disaster. People are fleeing the island in droves. There's all kinds of stuff, but this is the beauty of this country, is that there's always opportunity, and that there's the ability to actually create your own future, assuming that the framework to create that future exists. That is, I think, the role, at least that I play in the programs that I run, as well as being a cheerleader for innovation inside the Obama administration, is that if we're trying to serve innovative entrepreneurs, no matter of color, race, gender, sexual orientation, whatever, that we gotta be as innovative as they are. And government, no offense to my government colleagues sitting next to me, is not known for being innovative. So you gotta be willing to break glass. And the commitment I gave to the White House when they appointed me was that I was gonna break glass and push the envelope to ensure that we were doing as much as humanly possible. It's not enough, but I think that the private sector, the public sector, NGOs, endowments, foundations, entrepreneurs, big and small companies, they all have a role. And the idea of public-private partnerships are getting rethought. The idea of investing with impact investing is getting rethought. The idea of starting a company based on a technology is also being rethought. Oh, by the way, there's a global market that wants to eat our lunch. So we're not just competing with the guy in the community or with the guy in the other state. We're competing with a guy from Bangladesh that wants to eat your lunch. That sounds like bad news. That's actually really good news, because it makes us run faster. It keeps us hungrier. And I think for all the problems that we have, we are still the best place by far to live and to prosper.
Thank you. Vice President Johnson?
I think the issue, one, does go back to education, but not just education in the sense of high school and college in the STEM fields. But I think one thing that the administrator said was that technology is really democratizing entrepreneurship and the opportunities to be an entrepreneur. Like I said, how much less expensive it is to actually operate a business because of other people's innovative ideas are becoming greater and greater opportunities for our young people that want to start a business and who are becoming of the mindset of, I don't ever have to necessarily work for anybody if I can have the right idea and learn how to implement it. So the issue of, if you're talking about the STEM fields, which I know is the focus of STEM for us, is one, getting our young people to understand the value of these fields and making sure that we work with the high schools and the universities to give them the right introduction to it, such that you have the, I know an award in posterity was given to Mr. Stokes, and I'll tell you, when I first got on the Hill, Mr. Stokes' office, because he was the head of, he was the subcommittee ranking member on one of the appropriations subcommittees, and he called our office, and we had just gotten here, so we didn't even know what the appropriations process was, but he called us and said, do you want money for a SEMA program, which is a program that's run by NASA, and even though it's run in the university, it is called Science, Engineering, Mathematics, and Aeronautics, something to that effect. And it's run for junior high school and high school students where they get a hands-on look at what happens in the technology fields. But it's run, we have in our district, in Mr. Meek's district, it was run at a university, so they also get kind of a introduction to university life. So you start from there, but then you also teach them, hey, if you want to do something like this on your own, here is how you run a business. Here is how you figure out financing. Here's how you figure out supply chains. Here's how you figure out expense. It's not just a question of you want to do it. And understanding that, you know, I used to do a lot of counseling for people who wanted to go into business working at the Development Corporation, and getting them to understand your role is to convince someone else that you have what they want. It's not about coming and telling them, you have to give me something that I want. No, the point is you want to do business with me because it's good for you, not because it's good for me. And understanding that they need to be a serious player in that, which is one of the reasons that we're opening up the NASDAQ Entrepreneurial Center. And one of the things that we're doing, we're actually holding auditions for Shark Tank out there too. So that's one of the things we're doing. And if you watch that show, you kind of see, even though, let's be for real, reality television is not really real, a lot of other things go on, you know, behind the scenes before somebody says, I'm really going to do a deal. But the point of understanding, what does that potential investor want to hear from you before they're going to give you their money? Because no matter how wealthy they are, everybody has a limited amount of resources, and they want to put it where they think they're going to get a return.
Thank you. So we are going to close at this point. I want to thank our panelists for participating in this roundtable, and I'd like you to join me in thanking them for their insightful words.